Welcome back to the channel. Kindly like, subscribe and share for more trading content. In today's video, we're taking a fresh look at gold, XAUUSD, using this updated technical setup that includes 4-hour supply and demand zones, breaker blocks, channel structure, Fibonacci levels, and our take profit targets, TP1, TP2, and TP3. And near the end of this breakdown, we'll also talk about how the upcoming Federal Reserve monetary policy decision could influence this entire analysis, because fundamentals and technicals often collide at key moments. Let's get into it. 1. Key structural zones. The first thing that stands out on the chart is the major 4-hour supply zone sitting just below the 1.618 extension around 4,339. This is where sellers previously took strong control, and it may serve as major resistance if price pushes back into it. Below price, we have two stacked 4-hour demand zones, the first one between 4,180 and 4,195, and a deeper one resting at the neckline area around 4,146. These are high probability zones where buyers may step in aggressively. 2. Breaker block. Beneath these zones is a major 4-hour breaker block between roughly 4,070 and 4,110. This acts as the last line of defense before a larger correction unfolds. 3. Fibonacci levels. Price is currently moving within a key Fibonacci retracement cluster. 38.2% at 4,191. 50% at 4,205. 61.8% at 4,219. This is a classic decision zone, often leading to major breakouts once either buyers or sellers take control. 4. Trend channels. We also have three major channel structures, the white macro channel defining the broader bullish trend, the red channel showing the short-term corrective structure, and a yellow descending resistance line connecting the previous swing highs. Price is currently compressed between these lines, and compression usually leads to expansion. 5. Bullish scenario. For the bullish outlook, if gold holds the upper 4H demand zone and breaks above the yellow diagonal resistance, we could see momentum push into TP1, TP2, and eventually TP3. This scenario would show buyers regaining control and driving price back into the larger trend channel. Kindly like, subscribe and share to keep updated with more trading content. 6. Take profit levels. TP1 right pointing arrow TP3. Now let's talk about targets. Inside the green trade projection, we have TP1, located just above the fib cluster, around 4,240 to 4,250. This is the first reaction level where price often pauses. TP2, aligned with the upper boundary of the red channel, around 4,300 to 4,320. This level sits just under the 1.0 extension from the previous swing. TP3, placed near the top of the white macro channel, around 4,350 to 4,360. This also lines up with the 1.618 extension, making it a strong final target. 7. Bearish scenario. If price breaks below the 4,146 demand zone, this will expose the lower demand zone, and ultimately the 4H breaker block near 4,070 to 4,110. Breaking into the breaker block would signal a deeper correction and invalidate the bullish setup. 8. How the Federal Reserve monetary policy decision affects this analysis. Now let's talk fundamentals, because the Fed's upcoming policy decision can heavily influence gold's direction. If the Fed signals rate cuts or a softer policy stance, the US dollar typically weakens. Real yields fall, and gold becomes more attractive. This scenario supports the bullish outlook and increases the probability of hitting TP1, TP2, and even TP3. A dovish Fed often causes gold to break through resistance zones more easily, especially if liquidity is already sitting above current price. If the Fed signals rate hikes or a hawkish stance, the dollar strengthens. Yields rise, and gold usually pulls back or consolidates. This would increase the chance of price falling toward the 4,146 demand zone, or even the breaker block below if selling pressure accelerates. A hawkish tone often triggers sharp short-term sell-offs in gold, especially if the market was positioned bullishly beforehand. Why this matters now? Gold is currently compressed between major technical levels. That means the Fed decision could be the catalyst that decides the breakout direction. A dovish decision may push price straight into TP1 and beyond. A hawkish decision may send price right back into the lower demand zones. So both the technical structure and the upcoming Fed announcement are aligned for a potentially explosive move. Final thoughts. Gold is sitting at a major inflection point. The technicals show compression between supply and demand, while the fundamentals show potential volatility from the Fed's monetary policy decision. Watch the key levels, watch the reaction zones, and be ready for volatility. As always, trade smart and manage your risk. Thank you for watching. Kindly like, subscribe and share for more trading content.